Hey everyone, welcome. Today, we're going to dive into a tiny little detail in your bank account that could have a huge impact on your taxes. It's all about the descriptions you use for your money transfers, and trust me, getting them right is way simpler than you think.
So let's just jump right in with a question. When money lands in your bank account, is it automatically taxable income? It seems like a pretty basic question, right? But answering it incorrectly is a mistake that could be costing you real money.
The answer is a big, clear, resounding no. Not every single deposit is income, and understanding this one difference is the absolute key to making sure you're not overpaying on your taxes. Stick with me, and I'll show you exactly how it works.
So let's talk about a super common tax mistake, just misdescribing your funds. Here is the one core principle for everything we're talking about today. Tax isn't about the money simply entering your account. It's about what that money actually is. See, it's not the transaction that really matters, but the story behind it. And that story is what determines if it's taxable. Because without a clear story, a tax authority might just assume it's income.
And this slide just lays it out perfectly. On the left, if you have a vague or just plain wrong description, it can make any deposit look like income, which means you might end up paying extra tax you don't even owe. But look on the right, a correct, truthful description makes the whole thing crystal clear. It shows what the funds are for, ensuring you only pay tax when it's actually required. It's all about being accurate, not ambiguous.
Okay, so how do we actually put this into practice? Let's get into what I like to call the description principle. Really, it's all about just using the right words in the right situations. Simple as that.
We're going to walk through 5 super common scenarios where money you receive is not income. Things like getting cash from family, a friend paying you back, or even just moving your own savings around.
All right, let's get practical.
First up, money from family. Maybe your parents send you some cash for your birthday or to help you out with rent. That's not income, it's a gift. So the person sending it should simply describe the transfer as gift or family support. Done.
Next up, let's say you cover the bill for dinner and your friend sends you their share. You haven't earned any money, you're just getting your own money back. A simple description like refund or reimbursement for dinner clarifies that you're just settling up.
Oh man, this one happens all the time. You move money from your checking to your savings or between any 2 accounts that you own. This is 100% not income. Describing it as a personal transfer or transfer to savings makes it obvious you're just moving your own funds around.
Now, what if you borrow money? Well, a loan is a liability, right? It's something you have to pay back. So it's basically the opposite of income. You've got to make sure that transfer is clearly labeled loan received to correctly identify it as borrowed funds. And finally, for all you entrepreneurs out there, when you put your personal savings into your business, you're not paying the business, you're funding it. The correct term for this is capital contribution, and using that specific description keeps your books super clean and accurate.
So really, you should think of your bank statement as your financial story. Every single description is another word, another sentence in that story.
The takeaway here is really simple, but it's powerful. Your descriptions matter a lot. But let's be crystal clear. This is all about being accurate and truthful. These labels only apply when they reflect what really happened. This isn't some kind of tax loophole. It's just honest, proper bookkeeping.
So I'll just leave you with this question to think about. What story are your bank descriptions telling right now? And maybe more importantly, what story will you have them tell from now on? Thanks for tuning in.